Yes. So welcome, everyone. Lovely to have you here this evening with us at our Savvy Ladies workshop with Synchrony. We're just so thrilled to be able to give you and share with you this great information around building credit confidence. Today is part 2 of our workshop series, and I'm just so pleased that Savvy Ladies has been able to partner with Synchrony and to have you all here tonight. So with no further ado, I know time is short and we all want to become credit confident and as we head into the holiday season. So Kathy, please take it away and let's start the session.
All right, thank you. So I'm Kathy Dolson. I work for Synchrony. I also want to introduce Martina Davis. Martina and I are partnering together on the series. So we're on part 2, like Judy said. And so we're just going to jump right in. And so while we're doing this, please feel free. Let's make this interactive, right? So if you have questions, please, just, I don't know if there's a hand raising function or just, call out your question, type it in the chat, but let's make it interactive and we don't need to hold the questions till the end. Okay, so let's jump in. Really quick, we need to do a quick disclaimer. So the content that we're sharing in the presentation is for informational purposes. It should not be interpreted as professional advice or an endorsement of Synchrony Financial. All right, so we're going to jump in. So for those who weren't able to attend the first part, which was all about understanding your credit score and credit bureaus, this is just a super quick recap. But I think, Judy, that session was recorded, right? And
Yep.
I think there is a link to that, I'm guessing, on the Savvy Ladies website.
Yep,
So
and we shared it.
Yeah, okay, great. So if people are interested in the credit score piece, it's out there. So just as a quick summary, right? Most people can't pay cash for everything in their entire life, right? And so building your credit and having a good credit score is important because at some point you're probably going to need to buy something big like a house or a car, and you're probably going to have to finance that. And if you want to be able to finance that with a good interest rate, you need to start building a good credit history and have a good credit score. So part of building that good history and creating that good score is reviewing your credit reports, making sure everything on there is accurate, looking at your credit score regularly, trying to, get it as high as you can. Paying your bills on time is the best thing to do to raise your credit score. And then paying down balances to avoid paying a lot of interest is a smart thing to do as well. We're going to talk a lot about interest today as we talk about, smart ways to use credit. All right, so we're going to start a little bit basic, but this is going to quickly get a little bit more complex. So just bear with me through some of the basics. I promise you, if this seems basic now, we'll get into some of the good stuff. Just a quick distinction here between debit products and credit products. So debit is, kind of like your ATM card. And if the ATM card has like the Visa or MasterCard or Discover logo, you can go use it at a store where those, payment methods are accepted, and you can use it and it deducts the money immediately from your checking account or savings account. So that's the primary use of, example of a debit product. And then there's also prepaid debit cards, right, where you can preload money, usually from your bank account. And then once you preload it on that card, you can only use up to the amount that you've preloaded on that card. All right, and then credit is really the focus of what we're talking about here, which is, credit cards, all types of loans, such as car loans, home mortgage loans, student loans. And we're going to talk a little bit more, we'll go in depth a little bit more on the pay in 4 loans, which are some short-term installment loans, because those are a relatively newer product in the market, and wanted to make sure everybody understands how to use those wisely as well. All right, so when you use credit, you've got to pay that money back, and that is, they're all loans, right? So even your credit card is really like a loan that has to be paid back. And so when you're thinking about what product you want to use to pay for all of your purchases, it's good to actually think strategically about, do I want to use my debit card or do I want to use my credit card? Obviously, for the big things like a house and a car and some of the big things, that's a little bit, right? You can't necessarily put your house on your credit card, so that's going to be a mortgage loan. But I just wanted to make the distinction here between kind of like those everyday purchases and what type of product you want to use. And some of the, sort of pros and cons for each. So if you're using your debit card, it makes it really easy to stick to a budget because there's no way that you can overdraw off your savings account, right? So immediately that money is taken out, and you can't charge more than what you have in your savings account. So that keeps you sort of super honest and sticking to a budget. That's one of the big benefits of the debit products. On the credit card side, those can help you build credit if you use them wisely and if you spend within your means, and they can definitely help you pay for large expenses or unexpected expenses. So that's a big advantage of using your credit cards. So they're reported to the credit bureaus so they can help you build credit. They do require a credit check. So when you go to apply for a credit card, they're going to pull your credit bureau, look at your credit score, and see if they think you're likely to be able to pay back the credit card. You're going to get charged interest. There's a couple examples where you might not get charged interest. We'll talk about those later, but generally you're going to be charged interest if you don't pay your balance in full every month. And so that could be a downside. They might have an annual fee. But as a pro, they might provide some perks, right? You might have a cashback card, you might be getting points towards travel or some other thing. And so there's a lot of advantages to using credit cards. But the point is, before you pull out your credit card or your debit card, make sure that you're thinking strategically about which of those products you want to use. Okay. I'm going to keep checking the chat, and if I don't see anything or if I don't see, people jumping in with questions, then I'm just going to keep going. But again, if you guys have questions, feel free to jump in and ask. Okay, so let's talk a little bit about the pay in 4 loans, because these are a relatively newer product in the market. They're really popular with the younger generation, who are maybe don't, they're not as comfortable with using credit cards, or they've seen maybe the problems that people get into sometimes when they use credit cards, and so they want to stick to these pay in 4 products. They're also called buy now, pay later loans. On the right-hand side, there's some of the logos for the more common ones. And you might see it if you're online. You might see these, when you go to check out, pay in 4, and you might see their logo, and you can, click on it to see if you're approved to, for this pay in 4 loan. So typically you have to link it to a bank account when you purchase. Some of them might allow you to link to one of your credit cards, but generally they're going to want to link to your bank account. There's no interest generally, but they may have late fees, and it does vary, from issuer to issuer. And they're typically 4 payments, and you make the first payment immediately at the time of purchase, and you're paying for essentially 1/4 of that product immediately, right? So let's say you bought a $200 pair of shoes and you want to do it on one of these buy now, pay later loans instead of putting it on your credit card or your debit card. So what will happen is that you'll tie it to your bank account. They immediately withdraw $50 out of your bank account, right? And then 2 weeks later, you pay the next 50, 2 weeks later, the next 50, and then finally you pay it off. So it's a very short-term loan. And generally those payments are coming about 2 weeks apart. Generally, it will not help or hurt your credit. For the most part, these issuers are not reporting these loans to the credit bureaus. The exception right now is Affirm, and they've started reporting to TransUnion and Experian. The government is trying to get them to report, and they're, for the benefit of the consumer, there's a lot of good things for having these issuers report to the credit bureaus, but they're just not making a lot of traction right now. So this could be a good thing, right? If you're not able to make the payments, it won't hurt your credit score. But if you're making good payments, it's not going to help build your credit. So things to think about before you use one of the pay in 4 loans. And it could lead to overspending. It's hard to keep track, especially if you're taking these pay in 4 loans out, if you're taking out several at a time. You may not know how much you have outstanding. You might not know when those withdrawals are going to be made to your savings account, because they won't send you a bill. They literally just go in. They might send you a notification, but they'll just go in and start drawing that money out of your savings account. So just a caveat there. Is this like Shop Pay? I am not exactly sure. I thought Shop Pay was, Shop Pay may have multiple products. If they have a pay in 4 product, then this could be like Shop Pay, but I thought Shop Pay was more like a platform. Does anybody know?
Yeah, I think that it's probably embedded in Shopify, but there might be an installment offering, as you suggested, Catherine. So it probably
Yeah.
be a lot like one of these.
They might offer a pay in 4. There's a lot of places now offering these sort of pay in 4 loans. There's also some that are a little bit longer term. They're not always pay in 4. They might be, a 6-month payment, like a 6 months installment loan. So, you just have to kind of look and read what you're getting into. Are the payments taken out automatically every month, or do I need to make the payments? These pay in 4 loans, they are taken out automatically. So once you tie it to your savings account, which you need to do at the time of purchase, they will automatically withdraw. Like I said, I think they will send you a notification that the withdrawal is coming, but they just take it out. I did a payment over time, and now I can't see how many payments are due and how many I have paid. Yeah. I don't know, Dee, did you want to share any more about that?
Oh yeah, it was something that I split. I think it was on Shop Pay. And
Okay,
now I'm trying it was like 4 payments.
track it.
And then all of a sudden now I can't really see, maybe it was 10, because obviously if it was 4, I would have remembered how many, but it's very confusing, and I have to say I don't really love how it seems very sneaky. Like if I'm not paying attention to it, they could just take out again, like,
Exactly, that's what I'm saying. So I think, again, there's pros and cons to using this as a payment method, but
right.
just be careful. Or maybe you just need to track it yourself, like on a piece of paper or a little spreadsheet.
Yeah, I
Because
know that's what I have to go back and sort of figure it out. But
yeah,
because so many things are online now where it's like, okay, whatever, you take this class, you do the thing, they take 4 payments or 10 payments, and then it's like, yeah,
yeah, exactly. Savvy Ladies is suggesting you check your bank statements. It's true. You could see, how many withdrawals they've done and maybe
right.
how more you have left to
Yeah, I
go.
think I don't know how many are supposed to be coming out on that particular product. So that's what I was curious.
Yeah. Okay, so let's go on. Again, a little bit basic here, but just wanted to point out that there's several characteristics of different credit products. The first is revolving versus installment. So if you take out an installment loan, it's really a one-time loan, right? You take out a loan for something, it could be a small purchase, it could be a big purchase, but it's a one-time loan, and then you pay that back over time, generally in equal payments. There's a fixed term, it could be 3 months, 6 months. If it's a mortgage, it could be 30 years. So the term varies, but it's a fixed term. And by the end of that term, you pretty much have to pay off that loan. So that's an installment loan. A revolving loan is a line of credit that remains open indefinitely, like on your credit card, right? So when you open a credit card, they give you a credit limit and you're allowed to spend up to that limit, right? So you might make some purchases and then you pay it down, and then maybe you spend more and you pay it down. So that balance is going up and down, versus on the installment loan, your balance is generally coming down over time as you're making those payments. On an installment loan, you cannot request a higher credit limit, right? It's a one-time purchase that you're paying down. On a revolving loan, like on a credit card, you can request a higher credit limit, usually by calling in, or, if you have the credit card app on your phone or on your laptop, there's usually a place where you can ask for a higher limit. So you can call customer service. So those are some differences between an installment loan versus a revolving loan. Then there's also secured versus unsecured. In a secured loan, that loan is secured by some type of asset, and that asset becomes the collateral for the loan. And then there's usually a lien placed on that asset, right? So if you take out a mortgage loan, there's going to be a lien on your house until you pay off your mortgage. A car loan, they're going to put some type of lien on your car. And then if you don't pay back that loan, the lender can seize that collateral, right? They can repossess, right? They can foreclose on your house, they can repossess your car or your boat or something big like that. So generally, because there's an asset tied to the loan, there's lower interest rate on secured loans. Now, if it's an unsecured loan, which would be a lot of like your credit cards and smaller loans, that's not backed by any collateral. And so typically the lenders are going to charge a higher interest rate because there's more risk for that lender, because if you don't pay back your credit card or your short-term installment loan, they have nothing to seize, right? They're not going to come to your house and take back your shoes or your, purse or whatever you bought, your groceries. They're not going to be able to repossess any of that. And so generally the risk is a little higher, so the interest rates are going to be higher on those. All right, let me see. I'm checking the chat here. Let's see. How many times in a year should you check your credit score, and what is the free site you can go to? So we covered that in the previous section. There is a site called I think it's called Annual Credit Report or Free Credit Report. I'm trying to remember what it was, that you can go to. You can also go directly to the credit bureaus, so transunion.com, Equifax.com, and Experian.com, and each of those credit bureaus will provide you a credit report free once per year. Do we get a link to the slides you are showing? Yes. And I believe they will be on the Savvy Ladies website as well, right? So again, to learn more about the credit scores and how to get your free credit score and credit report, that is also already out there, Judy, I believe, right? Okay. All
Yep,
right.
correct. And we can send both recordings to everyone who's attended.
All right, good. All right, so the next 3 slides are going to talk a lot about, actually 4 slides are going to talk a lot about interest rates and fees, because this is a really important part about being credit confident and using credit wisely. So you really need to understand how much you're paying to borrow this money. And that's really determined by the interest rates and the fees. So the interest rate is also called the annual percentage rate, or APR. It could be a fixed rate. It could be a variable rate. When you take out that loan on that credit card, it's going to be in the initial sort of terms and conditions that they provide you. And they'll tell you if it's a fixed rate or a variable rate. Generally, credit cards are a variable rate, and it's tied to some government interest rates, but it should tell you in those terms and conditions what your rate is and how it may vary. I think they have to send you a notification if they change your rate. So you should get a terms and conditions notice. A lot of people don't read those, but it's always good to at least glance through them and see, if your rate is going up. So for a credit card, the interest amount that you pay is actually based on your average daily balance. So the credit card companies are looking every single day, and then they take that annual interest rate and they divide it by 365, because there's 365 days in a year, and then they apply that to the balance that day. So your interest is being charged literally every single day. And then at the end of the month, when they send you your statement, they sort of add up all those little daily interest rates, and that's the interest you're paying that month. So if you don't pay your balance in full each month, you're going to need to pay that interest. Okay, and there might be different APRs for your purchases, right? You might be charged one APR. If you're taking out cash advances on your credit card, that could be a different APR. And if you're doing balance transfers, that might be a different APR as well. So it's really important that you read, the terms and conditions that are sent to you and understand what those APRs are. On the right-hand side, these are sort of generally where the APRs are today, but the APRs vary greatly based on your credit score and the lenders, how much you're borrowing. So it's always good to look around. You can do a lot of research on the internet now and find out what are the good rates. Some of these rates vary, there's wide variances, like on credit cards, those rates could be anywhere from 15 to 30% today based on your credit score and the type of credit card that you're using. And we're going to see in some of the next examples, there's a huge difference in how much interest you're paying when your rate is like 15 versus 30%. Okay. Then talking about the fees, right? So fees could be charged for a bunch of different reasons. You could get a late fee if you don't pay your bill on time. That late fee may go up after you miss one payment. That's called penalty pricing. But you also might be able to get your late fee waived if you call, especially if this is maybe the first time that you're late, or you're not late that often. If you're a good customer, it's always good to call and see if the credit card company might waive your fee. And then there could be annual fees on the credit card. Those vary greatly. So consider, if you're paying annual fees on your credit card, is it worth it? There's a lot of good credit cards out there that don't have annual fees, but to get some of the really nice perks, you might have to pay an annual fee. So you really have to consider, is paying that annual fee worth it for you? And again, sometimes if you call in, they might waive the first year. Or, if you say, well, I don't want to pay this fee anymore, I'm going to close my account, they might go, oh, well, I'll waive the fee for you if you're a good customer, because I want to keep you as a good customer. So again, always good to call and see if you can get your annual fee waived. There could be other fees. I think we talked about these, like cash advance or balance transfer. So again, always good to read and make sure you're understanding all of these charges for borrowing money. What happens if you pay your credit cards off early before the end of the month? Yes, that is totally possible. And you can make as many payments during the month as you want. Even your mortgage, and we're going to talk about this a little bit more. You can always pay early. It's rare that there's a penalty to pay off your loan early. So again, you could call and ask if there is, but generally there's not a penalty. Most lenders don't mind if you pay back a little early, because that's a sign of good behavior. Okay, so I'm going to keep going. So the next few slides, we're going to go through a few different examples of how much you're actually going to be paying for interest in some of these scenarios. So this is a case where we're talking about credit cards. And let's just say you've got $1,000 balance on your credit card and you're only making your minimum payment of $35. And there's 3 different scenarios here talking about interest rates from 10%, 20%, and 30%. On average right now, the credit card interest rate is 25%, although like I said, that varies greatly based on your credit score. and the type of credit card you're using. Let's look at the 10% case first, right? So if your interest rate is 10%, $1,000 balance, you're making your minimum monthly payment of $35, you're going to end up paying $147, and it's going to take you 2 years and 9 months to pay off that balance. That's a long time, right? And that's assuming you're not charging anything additional, right? And then the other end of the spectrum, on a 30% interest rate, you're going to pay $776 in interest. It's going to take you 4 years and 3 months to pay off that balance, right? So a lot longer, a lot more interest because the interest rate is higher. So there's calculators online, and I think we said in the next session, which we're going to talk about a lot of debt management, we're going to share some of the calculators that you can use to play around with some of these numbers. So you can see, hey, if this is my balance and here's how much I want to pay every month, how much am I going to pay in interest, and how long will it take me to pay back? So there's a lot of good tools and calculators out there. All right. I'm going to keep going. Okay, so this next example is about your mortgage. And mortgage is probably, you know, the biggest, if not one of the biggest loans that you'll probably ever take out. And so there's a lot of interest because you're paying that loan over a long time, right? The standard is like a 30-year, you know, fixed rate mortgage payment. But if you pay that mortgage more frequently, you can actually reduce a lot of the interest that you're getting charged. So in this example, if you just pay your mortgage once a month, let's say it's a $300,000 mortgage, 30-year mortgage, 6% interest rate, and you're paying, you know, once a month, $1,800, you're going to end up paying over the life of that loan, over the 30 years, $348,000 in interest, and it'll take you 30 years to pay it off. Now, if you switch your payments to biweekly, every other week, and you split that payment in half, and you say, I'm going to pay $900 every other week, your interest goes down by $74,000, and you actually pay off that loan 5.5 years sooner. So that's a huge difference just by switching your payments from once a month to biweekly. So it's a little bit sneaky. If you're doing it biweekly, because generally there's more than just 4 weeks in a month, you're actually making another, you know, sort of extra couple payments each year. And if you can afford to do that, it's a great way to save some money. So, you know, and if a lot of people, you know, get paid every other week. And so it's a nice thing to do. You can kind of time it to coordinate with your paychecks, a great way to save some money. Okay, so I'm going to look for some questions here. So requesting a late fee reversal is a wise action to take. With the federal government shutdown, many consumers may have to ask. Absolutely. I think there's a lot of lenders, especially for government workers, and they're not going to ask you to provide a lot of evidence or, you know, justification that you're a federal worker. Very willing to waive late fees and payments right now. So definitely, and you know, it's always good to call. Always good to call about any questions you have. Okay, last example here on interest rates. And this could apply to both installment loans and credit cards. So there's types of interest rates called promotional interest rates. We're going to talk about two. The first one is deferred interest, and the second one is 0% interest. And there's a difference here. So deferred interest is usually on an installment loan, or an installment loan, again, is where you take out you know, one loan and then you're paying it down over time. It's usually like a fixed amount over time. And you might see some type of marketing material that says, hey, no interest if you pay this loan in full within X number of months, right? So let's walk through an example where, let's say you make a purchase for $1,800 and you get a 6 months of deferred interest. So the first scenario is if you're just paying the minimum. So you're going to get a statement, whether it's electronic or in the mail, and it'll show you a minimum payment. And if you just make those minimum payments after 6 months, you definitely will have not paid the loan in full. And so not only do you have the remaining balance, which is like basically $1,400, but you're also going to have to pay all of that accrued interest that you didn't pay in the first 6 months. So the minimum payments are not even covering all of that accrued interest. Okay. Another scenario, right? So if you do want to take advantage of the deferred interest and pay it off without having to pay the deferred interest, pay it off in the first 6 months. So just take the total amount of the loan, which is the $1,800, divided by 6, which is your 6 month promo period and you get $300 a month, pay $300 each month, then you, at the end of the 6 months, you're done. You don't have any interest that you've accrued. You've paid it all off. And that's a smarter way if you can afford that. And if you can't afford 300 each month, you know, you can pay 200 one month, 400 the next. But the idea is that, you know, if you don't pay it off in the 6 months, you're going to get that sort of lump sum of interest that's accrued now that you haven't paid on top of whatever balance is left.
Kathy,
right, and then-
I'm just gonna
yeah.
jump in because I see that sometimes it's so misleading because
Yes.
they're telling you the minimum payment and you're
Yes.
making it so you feel good
Yes.
that you're making the minimum payment. They're not telling you or make
Right.
6 payments for this amount to pay it off in full for the duration of the time
Yes.
frame.
Correct. That's why these are really tricky, and they can be misleading if you don't really understand the credit product that you are, you know, asking, you know, to be approved for.
Right, because I think there is, and it's the language, and that language is not changing right now.
Mhm.
Because the minimum payment is, you feel like, oh, I've made the minimum, I did good,
Mhm. Mhm.
but it's
And
not.
yeah, well, and it's good in the fact that like it's not going to hurt your credit score, right?
Okay.
Because you're not delinquent on that loan, but you're going to end up paying a lot more for that
Because
person
of the interest
because
at
of
the
the
end.
interest, right? The interest is really the most expensive thing on all these loans, much more so than the fees. Like the late fees are smaller compared to the amount of interest that you're paying. So it's
Because
really
they
important
hope,
to
they want you to pay.
understand the interest. Yeah. And then
Something to really be careful of for
Yeah.
everyone on the call. Like you need to do that math in your head and make that out yourself so you can pay that and set it
Exactly.
up as an automatic if you have the money to do something
To make
automatic
those
to pay it
payments.
down.
Yeah,
Yeah.
exactly.
Well, thank
No,
you.
yeah, no, that's a great distinction. And then the 0% interest, this could be on like a revolving loan, such as a credit card or an installment loan. And what the marketing materials might look like for this one is 0% interest for the first X months, right? And so here, in this case, the interest does not accrue during the promotional period. But if you don't pay it off, right, then you will have interest that starts accruing at the end. So you might see this kind of loan when you get a credit card offer. If you're out there shopping for new credit cards, some of the promotional material might say 0% interest for the first 6 months on this credit card or first 12 months, whatever. All right. So the way to take advantage of that would be take that credit card, transfer the balance from an existing credit card you have to that new credit card, and then basically accelerate that balance pay down while there's no interest accruing, right? Because like we saw in the last example, if all you're paying is the minimum payment on your credit cards, there's a lot of interest that you're continuing to accrue. That payment is going first, not just to pay down the balance, but whatever interest is due, the payment goes first to the interest and then to the balance, right? So you might be making your minimum payments, but most of that payment might be going towards just the interest and not paying down that balance. So if you can get this 0% interest on a new credit card, you can take the money that you would have paid towards, you know, making your minimum payments on the old card and really try to accelerate that balance pay down while you don't have any interest accruing. You can save a lot of money by gaming the system that way. Now, not everybody's going to qualify for these 0% interest, right? You're going to have a pretty good credit score. But if you do have a good credit score and you're trying to pay down debt, this is a great way to get ahead of that pay down. Another place you might see the 0% interest is on installment loans, right? So you go to buy a new, you know, oven or dishwasher, and they're going to offer you some promotional financing. And here, again, it's kind of like a free loan. So if you can just take that total loan amount, divide it by the number of months in that loan, and pay that over time, pay it in full, you will get essentially a free loan because you will have paid it off before any interest will start accruing. All
And
right.
I just want to make a quick comment on
Yeah, go ahead.
in the chat about the benefits of a financial advisor. The one thing I would say, I would encourage you to reach out to the Savvy Ladies Help Desk, but also like it does, and we'll talk about this in the next session, it requires a lot of organization in order to work with a financial advisor. So I do encourage everyone, like you still have to take the time and put all of the things that you're spending together to get the best benefit out of that. And so I think, you know, sometimes we just have to do the work to make sure that we're organized around our finances.
Absolutely. Yeah. Thanks, Martina. Okay. let's keep going on. I'm looking at a time check here. Okay, I think we're doing pretty good. Okay, we talked a little bit about these credit builder products in the last session, but I think it's so important. And again, these are super confusing. So I wanted to do a little bit of a deeper dive during this session. So again, you'll see a lot of this, products advertised as, hey, we can, help build your credit score, repair your credit score. And so a couple of the broad categories for these products. The first one is a secured credit card. And I've listed, kind of a few logos up there, but most credit issuers offer these types of secured credit cards. And the way that these work is that you will make a deposit into a checking account. So if you're getting a $500 credit limit on your secured credit card, what you need to do is you make a $500 deposit into a savings account, right? And then they give you a $500 credit limit. So you're allowed to make, purchases up to $500 and pay those down over time, which does build good payment history and utilization history. But it's going to require this upfront deposit. And so that money is going to just kind of sit there, and it may earn, a low interest rate as they're holding it. It may not. So again, read the fine print there. But there may be some fees. And on the credit card part of it, there might be some high interest rates. So again, really important to understand what's the interest rate that you're paying for. If you have really bad credit, or if you don't have any credit, it is easier to get approved for a secured credit card than it is for, let's say, an unsecured credit card, like your general purpose card. But if you don't need to use a secured credit card, probably better to just use your unsecured credit cards if you can get approved for one. All right, and then the second category, they call these credit builder loans. And the term loan is very misleading because they're not really lending you any money. So what happens with this one is you will, if you're sort of approved for like a $500 loan, you don't get any money up front. You over time pay into a account, a secured account, and then that credit builder loan issuer is going to report those payments to the credit bureau saying that you're making these payments. But all you're doing is sort of paying into an account. And then when that loan is over and you've paid all $500 into that account, they will give you most of that $500 back. They might hold back some fees or some interest. And so it's really not a loan in the sense that you're not getting any money up front. You're just paying into this account and then getting some of that money back later. So really be careful about this one. Again, if you've really damaged your credit and you're trying to build up your credit score, this could be a good way to do it. But if you've got extra cash, rather than paying into a credit builder loan, just pay down the balances on your existing accounts. So that may be a better way to use that extra money. So a couple of things to think about, not, for secured credit cards and these credit builder loans, they may not report to all three of the credit bureaus, right? So if they're not reporting to all three credit bureaus, if they're only reporting to one of the bureaus, your credit score might go up for one credit bureau, but not for the others. And so it's really important to understand what you're getting into, like really understand the fees, the interest rate, any other charges that they're going to have, and try to understand how it's going to impact your score. Some of these, the impact to your credit score may only be, a small number of points. It might be 10 points or 15 points. It may take a long time for, those on-time payments to really start building up your credit score. So please use these with a lot of caution. Okay. Okay, now we've talked a lot about, interest rates and alternative products. Going to completely switch gears here because this was a question that came up in the last session, which is authorized users. We had a really good discussion on authorized users. So I did a little bit of research and wanted to go a little bit deeper on the authorized users. So an authorized user account is generally applicable for credit cards. It's really not applicable for like a mortgage loan or an auto loan or a student loan. But what it means is when you have a credit card, the primary account holder can add another person so that that person is considered an authorized user. That person gets their own credit card and they can use that card just like the primary user can use that card. But they're not legally responsible for making any of the payments, right? So a lot of times you can add a spouse, you can add a child. Those are probably the more common ways that you would have an authorized user on one of your credit cards. Okay, so again, these could be good or bad. So it could be good if you're trying to build good credit and you don't qualify for credit on your own. You know, being added as an authorized user is a good way to start building credit because it adds credit history. And it can also add positive payment history. But there's some risks too, right? So if the primary account holder is not making their payments or they have a high balance, that could hurt you, right? And you, as the authorized user, don't have a lot of control over the spending and the payments because you're not the one legally responsible for making those payments. Generally, the authorized user cannot remove themselves from the account. Usually, and I think we did hear some exceptions to this on the last call, but generally most credit card companies will only sort of work with the primary account holder, whether it's to add an authorized user or to remove an authorized user or to ask for a credit limit. That's usually all done, credit limit increase, that's usually all done through the primary user and not the authorized user. I did find out because we have a contact at Vantage. So the two primary credit scores that most lenders use are the FICO score and the Vantage score. FICO is the most common. Vantage has been gaining a lot of popularity in recent years. But I did find out for sure, Vantage does not consider the authorized user account if it has any negative information, right? So that's great. Vantage is really giving the authorized users the benefit of the doubt. So only counting the authorized user information into the score if it's positive information and not sort of lowering their scores if there's any negative information. So I was really encouraged to find this out about the Vantage score. Did not have time to look and find out from FICO. I don't have a contact there, but I'm going to see if I can get one and find that out for FICO as well. So that could be my homework for next time. Okay, so I'm going to keep going because I don't see any more questions. Okay, so I wanted to spend, if the account owner dies, the authorized user loses access. I think that's probably accurate, yes. Okay, so credit counseling services. Again, there's a lot of information about there. People advertising, oh, we can erase your debt, you know, we can settle your debt for you. And this is another area where I think you need to be very careful. There are, you know, some non-for-profit organizations. I've listed 3 of them here. This is not an exhaustive list. Savvy Ladies does partner with the National Foundation for Credit Counseling. So I don't know, Judy, do you want to jump in and talk a little bit about that?
Yeah, no, I'm excited to share that. We know this has been a question for many of our clients, where to go, who can you trust, what's a scam, what's not a scam. And it is very complicated. You know, everyone wants to help you because, you know, there are fees associated with this. But the NFCC, the National Foundation for Credit Counseling, is really a wonderful nonprofit organization where they have member agencies that they work with that have to adhere to a trusted, accredited credentials that they work with clients. They'll work with you to make a plan. And that's what's really key, a debt management plan. And that plan will have fees, but it will be the lowest cost possible of fees that are administration fees. They're not charging you an interest rate or upcharging you because they will help consolidate and they will talk to those credit cards and work out the plans for you on behalf of the NFCC. So they're a larger group, and there's probably around over 300 organizations. Each of them have their staffs. So there's 1,000 or so individuals who are accredited financial counselors. So if this is something of interest, the volunteers are aware of this and will refer you if they think it's the right plan for you.
Okay, thanks, Judy. Yeah, and then so be careful because there are debt settlement companies that are not the non-for-profit. They are for-profit debt settlement companies, and they charge fees probably a lot higher than the.
And they also charge interest. So
Yeah.
they will charge typically interest. The settlement companies, I would very much be wary of, stay away from, because they will charge interest based on how much you owe. And they also don't guarantee that they will help you remove your debt. Whereas the making a debt management plan with one of the accredited nonprofits, they will. They will help, they will make sure that over a time period of, say, maximum 60 months, they will work through a plan with you to pay off. And there's also opportunities based on your income by state, and if you're military, to waive fees and to waive their low cost fees.
Agreed. Okay. All right, so we're getting to the end. This is good. So here's just some tips for using credit wisely, and then we'll just kind of summarize and then we'll be done. So using credit wisely, we've talked a lot about this, and we'll talk a little bit more, right? So living below your means, sticking to a budget, that's really going to be the focus of the third session on budgeting. So I'm going to introduce here this 50-30-20 rule, which Martina will talk more about in the next session. But, and as Martina mentioned, you really kind of have to do a little bit of the homework, right? To get your arms around what are your, what are your actual needs, right? Your housing, your groceries, utilities, your cell phone, what are your needs? What are your, savings, and what are your wants? And trying to stick to that 50-30-20 rule as you're building out your spending and budget plan is a good rule of thumb. Right. So another category of tips is how are you paying on your debt obligations, right? So you want to aim to quickly pay down your credit card balances. Setting up auto pay on your bills is a really great way to make sure that you are not missing your payments, and keeping your credit utilization below 30%. This is another one that we talked about last time that really helps your credit score if your credit utilization is below 30%. And utilization really just means looking at your balances as a percent of your credit limits. And, if you have $1,000 credit limit, let's say keeping your balance below 330 is like a good rule of thumb. So that 30% ratio between the balances and the credit limits. And then when you're using your credit cards, try not to revolve the balance on your necessities, right? You shouldn't be paying high interest rate on your groceries, right? You just ate them last week, so it doesn't make sense to put them on your revolving card and not pay off that balance immediately. You can set alerts on your credit card for charges and high balances. So, it's easy now to set up alerts if you've got the credit card app, so that anytime a charge comes through on that card, you immediately know the amount. That helps avoid fraud, helps you make sure that, especially if you have authorized users on your credit cards, who else is spending on that credit card, you immediately get notified. And you can actually set an alert, if your balance goes above a certain amount, and you can actually pick. Some of those credit card companies allow you to pick that amount. Like if you're trying to live within a budget and you say, okay, I can only spend $500 on this account this month, you can set notifications. If your balance on that account or on that credit card gets above 500, they'll send you like a text message or an email. So those are really great ways to help manage some of your spending. And then, as we talked about today, it's really hard to keep track of all your spending if you're using a lot of different credit cards or opening a lot of these small installment loans. And so it's better to sort of consolidate your spending to a few of those things, right? And when you're using a few things, then you can easily track the balances and try to maximize your rewards. Like if you have credit cards that have, cashback or travel rewards or some other type of rewards, try to use those cards to maximize your rewards. All right, I've seen a few questions. Okay, so I think Judy answered that one from Dee Dee. And then, is it a good idea to close credit card accounts when the balances are paid to reduce the spending? We talked about that last time. So if you are disciplined enough to hide that credit card in a drawer somewhere and not use it, it actually is helpful to keep that utilization low, right? So if you've got that credit card, let's say it's got $1,000 credit limit and your balance is zero, that's great because the utilization on that credit card is zero. And then your utilization on some of your other cards might be 30%, 40%, but your overall utilization then, so keeping those unused cards open really does help your utilization, and it helps you build your credit history, right? Especially if you've had that card for a long time. One of the things that also helps raise your credit score is having a long credit history. So having some credit cards that have been open for a long time is a good thing to help raise your credit score. So it's good to leave those accounts open, just hide it somewhere so that you're not tempted to use it. Okay, with the mortgage example, you showed where one can save on interest by paying biweekly instead of monthly. Can this also be true for car loans? I believe so, yes. I didn't do the example, but I think that should work as well for the car loans. I mean, anytime you're paying off a loan earlier, or more frequently is going to reduce the interest that you're paying on that. And again, most loans don't have penalty pricing right now. So I would check with the lender, but as long as there's no sort of penalty for paying, earlier or ahead or making larger payments, then that's always a good thing. Do the credit scores know you went through divorce? No, not necessarily. Like that is not considered at all. It's actually not allowed to be used in credit scores. So marital status is one of the prohibited variables, just like race and gender. And so it actually cannot be used in the credit score. All right, if you can, I would really appreciate it if you can speak about some spending tips for freelancers or those who don't receive the same monthly income every month versus those who do receive more stable income every month. Okay, that one is tougher, you're right, because if your income is variable and you don't have a guaranteed income month to month, I think it does become more difficult to do that budgeting and spending. Martina, is this something you plan to talk about with the
I think we can
budgeting?
talk about it. I think it just requires more projecting over a
Yeah.
year's basis. And then maybe thinking about, how you save, where you allocate funds, right? Because if you don't have money coming in every month, you might want to set aside a budget for your rent, et cetera. So I can, build in some content on that into the webinar next week.
Yeah, I mean, off the top of my head, I think maybe you just need to have a little bit more of a cushion. Sort of that rainy day fund, maybe that needs to be a little bit of a bigger cushion for months where you don't have that income coming in. But yeah, that makes it trickier for sure. Okay. But I think I missed a question here. I'm in the process of divorce and one of my cards keeps asking me to update my income. My income when married was much higher than it is now, and I keep declining. The only reason they're asking that question is because they want to consider you for a credit line increase. And in order to give you a credit line increase, they have to make sure you have the ability to pay that credit line increase. So anytime that you're applying for a credit card, the lenders are required by the government to ask for your income, and then they do some calculations to make sure that you are able to pay that loan back. This is one of the changes that the credit card companies had to make coming out of the 2007, 2008 great financial crisis. They said the lenders were over lending, not lending responsibly. And so now anytime you ask for a new credit card or a loan or a credit line increase, they have to make sure that you are able to pay back that loan, looking at your income and the debts that are sort of in the credit bureau. So that's why they're asking. You don't have to respond. If you do want a credit line increase, though, keeping your income updated in your credit card app is a good way to do it. The lenders can only use your income for 12 months, and then it's considered stale and it's not able to be used for this ability to pay calculation. So yeah, so you can ignore that. Let's see. I was an authorized user on all of the cards. Was that a question, Dee Dee? One should be aware.
Oh,
Women
you
should be
you
aware.
guys were just talking about
Okay.
the part where it's like, it does hurt your credit when you come off being a authorized user and you don't have that 15, 20 years of,
Yes.
being a credit card holder. So it's just something that women should be aware of. You can be an author. That's why I was asking if they could see if you were divorced, because if so, then you could have seen both. But that's where I got a lot of trouble
Yeah. Yeah. So I mean,
because I don't have that longevity
yes.
anymore.
Yeah. So when you if you are added as an authorized user, that will give you a credit score, and probably a good one, right? If the primary has a good, history on that account, then the way to do it would be open up your own card or cards in your own name and start building your own history immediately. Right. And then, so I would say that would be the way to do it. And if you have
So I
children,
was just saying that women in general should know
Yes.
that
Yes.
going into a marriage, because I didn't,
Yes.
I mean, and obviously I got married for the right reasons and was in love and became a user like that, but then when it didn't, then
Yeah.
it went away, so my longevity wasn't there, so
Absolutely.
I had
It's
no,
always good to have some things in your own name, right? So like
Yeah.
maybe the mortgage is a joint, loan, or the auto is a joint loan, but
Right.
women should always have some credit cards in their own names for cases like this.
yes,
So I would say if you don't have a credit history, right, start with an authorized user, possibly, but then immediately open up at least one credit card in your own name where you're the primary user and start building that history for yourself.
yeah,
It's a great way to help your kids start out too. Because again, like when they graduate from college or even high school, right, and they need a credit card for some things, it's a great way to help them start building a good credit history, as long as you trust them to not go crazy, and use the whole credit limit, which is where those notifications come in when there's any spending on the card. So. All right, I think I just have one more slide, but these are great questions. Oops. Okay, so summary. So using credit wisely will raise your credit score, will help qualify you for lower interest rates and the ability to finance large purchases. If you use pay in full loans, make sure you're very careful about tracking how much you spent on them and what your upcoming payments are. And maybe this is not just, let's say, for the pay in full, but also for some of those other short-term installment loans where maybe you're not getting a bill every month. Know your interest rates. Use your credit products with lower interest rates first. If you've got high interest rate, let's say loans or credit cards, try to pay those down first. As we learned with our interest, right? The higher interest rate means you're just paying more interest and it's harder to pay down that balance when you've got high interest rates. So if you're gonna put your money somewhere, start paying down the ones with the highest interest rates and focus on getting as low an interest rate as possible. Take advantage of any promotional financing you can, but try to pay in full before the promotion expires. Always use caution when you're using secured credit cards and credit builder products. And then try to work with a nonprofit agency if you're struggling with managing debt. And I know Martine is going to talk more about that next week for part 3, which is November 20th, taking control of debt. That was all the materials I have prepared. So we've got a few extra minutes if anyone has questions. Okay, do Savvy Ladies have counsel regarding the federal student debt? I'm considering study after my divorce, but I don't have any idea how it works. Judy, do you want to take that one?
We probably have one or two advisors who could answer a question around that. So it's worth putting it into the helpline. If not, one of the advisors probably can share some resources that would be safe to go to.
I would say, federal student debt probably has lower interest rates than, let's say, getting student loan debt through a private bank, but it's extremely hard to erase, right? Or to get out of, right? It's because it's with the government and they can start, and I don't think they've done this, but they have access to, trying to garnish things too. So I would just say, with the student debt, try to get, any types of scholarships, or there's a lot of places you can get funding for going back to school. Try to exhaust a lot of that before taking out a lot of student loan debt, because again, that takes a long time to pay back, sometimes decades, I think. So there were 3 parts to the series. This was the second part. Freezing your credit bureaus. So we might have talked about that last time. So freezing the credit bureaus could be good for a couple things, right? If you've had fraud, if you've had somebody use your information to open up cards or to take over one of your existing cards, you can sort of freeze your credit bureaus. And what that will do is prevent anybody from opening up any new loans in your name. So that is a good thing. But then if you do want to open up, let's say, a new credit card or take out a new loan, then you have to go back and unfreeze because you won't be able to take out any new loan. So it could be a good thing. All right. I don't see any other questions. Did I miss any questions? Because I was just trying to read through. So
No, I think you
if
got
I missed
all of
anything.
them. There's just a new one that came in.
Oh, can you demystify mortgages? Oh yeah. We could do a whole session probably just on mortgages, right? So just at a high level, right? There are some mortgages that are fixed. Like my example was a 30-year, fixed rate mortgage. So what will I would say the primary things are, is the interest rate fixed on the mortgage or is the interest rate variable? If the interest rate is fixed, you will know exactly how much you're paying every month, but that rate might be higher. If the interest rate is variable, it might be lower, but it's gonna move up and down with some of those federal interest rates. So you don't know what your monthly payments are gonna be going into the future. They might be higher, they might be lower. So that is a little more risky.
And then
But
Kathy, you can
yeah.
always look to
Always
refinance.
If the rates go lower, you can always refinance to your benefit. But sometimes if those rates go higher, you're kind of stuck with that higher payment if you've got a mortgage with a variable interest rate, right? So besides, and then the term of that loan varies, right? So there's 30-year mortgages, 20-year, 15-year. Martina mentioned, right, that they're considering a 50-year mortgage, which seems crazy. So, again, there's pros and cons to all of these things. You just have to make sure that you understand the pros and cons and what is best for you in your situation. I don't know, Martina, did you want to add anything about that 50-year mortgage since
Yeah, I
you know
think
that you
it's
wanted
an
to?
interesting concept, right? Because I think on the one hand, it does add affordability. But then you also end up with a mortgage that, most people I think buy homes in their 30s. And so this is a mortgage that you would pay off by the time you're 80. And then also like the amount of interest, you had that
That's it.
slide on the amount of interest you would accrue on a normal mortgage. On that, it's probably going to be twice the size, right? And so it's like, is that something that you're willing to undertake?
Yeah,
But
your monthly
that's
payments might be
very-
lower, but over time, your total amount paid is
it's a
much
lot more.
higher.
Yeah.
And that also just leads into your legacy and legacy planning for wealth. So
Exactly.
many women especially are buying a home for safety and security and hoping that that is their one big egg, the big bucket to turn that over to their families. And if a longer mortgage, and it's going to go to the bank, not to your children.
Yeah, or it'll be a debt to them that they have to take on.
Correct. So that's another thing to consider. It may not be a good legacy planning for so long.
Yeah.
Well, this has been terrific. I think we've answered all the questions. Looking forward to our next session. I think everyone enjoyed part 2.
Yeah, thanks everybody for attending.
Yeah.
Really, I appreciate the questions and appreciate everybody spending an hour, on your evening here with us to become more savvy in your finances.
Excellent. Well, we thank you for being here.
Yeah, thanks everybody.
Thank you.